Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. This week, I thought I would talk about my Kennedy channeling technique. I mentioned it, I was going to do that last week, and as you well know, if you've been a subscriber for any length of time, I often refer to the Kennedy channeling technique, not necessarily by name, but whenever I use the terminology like corrective price channel, base channel, things like that. That essentially is the Kennedy channeling technique. So that's what we're going to be focusing on and discussing this week. So exactly is the Kennedy channeling technique? Well, all it really is, it's a trend line algorithm, okay? So it's just kind of a fancy way of saying it's a very simple approach to drawing trend lines that allows you to identify the difference between corrective or counter trend structure and trending structure, counter trend price action versus trending price action. Okay, so I want to kind of go back in time because I developed this back in, let me think now. This would have been maybe 1999, 2001. It was about that time frame. So I've been using this technique for over 25 years now since I first developed it. Okay, and it really stemmed from a question I know as an Elliotician, because I was still kind of, and maybe I had about 10 years under my belt counting waves as a professional Elliotician. And there was always that one instance on a price chart where you could look at the market, such as this example here, 5 waves up, 3 waves down, 5 waves up, and you would think to yourself, okay, hey, this is clearly an ABC. This is clearly a zigzag. So what would be the appropriate course of action from, say, a trading perspective? Well, you'd be looking at some point for a total retracement of that move because, again, that would be a zigzag. That could be a wave 2, that could be a wave 4, that could be a wave X. Nonetheless, it was, or a B wave, but it was, bottom line, it was a counter trend move. And again, upon completion, it would be more than fully retraced. Okay, so this is, again, classic Elliott. Well, there would be also, too, if you can count this price action this way. Well, you can also, too, identify the same price action in a totally different context. For example, 1, 2, 3, 4, 5 for wave 1, ABC for wave 2, and then 1, 2, 3, 4, 5 for maybe a second wave 1. So what would happen here is, yes, the market would decline, and then that would be your red wave 2, and then all of a sudden, the market goes back up. Huge, okay? So how you interpret this price action has pretty, as you can clearly see, has pretty dramatic implications, certainly from a trading perspective. It's the same structure. Again, look at the blue lines. Look at the substructure. 535, ABC, and again, this is also too equally applicable, 1, 2, 1, 2. Okay, so I needed a technique that would allow me to, say, differentiate confidently the difference between these two types of formations. Okay, and my result, my answer, my solution to this quandary here was the Kennedy channeling technique. So what I observed after countless hours of research is that counter trend price action, corrective price action tends to be contained by parallel lines. So when I see something like this, the first thing I do is I draw a corrective price channel. Okay, so what I do is I start off with a trend line from the origin point of wave 1, draw a line to the extreme of wave B, and then take a parallel of that line off the extreme of wave A. As long as this move is contained within these two lines, the most accurate interpretation of this price action is that it is a counter trend move, that this is going to prove to be a corrective wave pattern. Okay, now over the years I've kind of learned to incorporate a center line, and I call this the center line of the corrective price channel. That's why whenever I draw my base channel or my corrective price channel, you'll actually see 3 lines: the lower line, the center line, and the upper line. Okay, so now let's look at an impulsive structure. Okay, now again, just kind of goes back to the key foundational principle of the Kennedy channeling technique. If counter trend price action is contained by parallel lines, then impulsive price action, by definition, is not. Okay, so whenever I see that 535 formation begin working, the first thing I do is draw my corrective price channel. Only when price action begins to move successfully above the upper boundary line of the corrective price channel, then does it become a base channel, and hence also to confirm the presence of third wave price action. Now you know, based on price evidence, that you're now working an impulsive move. Now, a secondary value of the base channel trend lines is that they often provide support for your fourth wave pullback as well. So simply put, the best way I look at the market, and again, I've been using this technique ever since I developed it, so that's 25 plus years. I continue to use it to this day. And you know that in your own commentary, I use it for my own trading. But again, the simple keystone principle behind KCT is that counter trend price action is contained by parallel lines. So again, by definition, if price action is not contained by parallel lines, it is not a counter trend price move. It is a trending price move. Okay, so let's look at a few more slides here. And again, I'm just going to go through some of the finer points of drawing the KCT, the corrective price channel. And then tomorrow we'll pick this up because I do want to explore the different variations. So for example, this right here, again, we have the ABC. We start off drawing the parallel line from the origin point of wave A to the extreme of wave B, drop the parallel down to the extreme of wave A, and what this does is it gives you support for the wave C, where wave C is likely to terminate. And it's going to be somewhere at or near that lower boundary line. This is what I call a bottom line reversal. Okay, now whenever you have a bottom line reversal, once you get above the center line, then that's going to be kind of a good indication or act as initial evidence that this ABC structure to the downside is indeed complete. Now, there are some corrective structures I've observed over the years that where the slope analysis of the decline of the ABC move down is a little bit different, a little bit skewed. And so, again, nothing changes. Okay, the key fundamental principles are still applicable. You start at the origin point of wave A, you go to the extreme of wave B, drop the parallel down to the extreme of wave A, and this is what I refer to as a center line reversal. Okay, now if this were to occur, then what I'm going to be looking for to, as far as price evidence to argue that the ABC is down and done, I'm going to be looking for price action above the upper boundary line of the corrective price channel. Okay, so that is just a straight, simple zigzags. Both of these patterns, the operative structure, underlying structure would be that of a zigzag. But again, you can see it's quite powerful, quite simple. I like simple. Simple tends to work. Okay. Now, I think that's about it for today because what I want to do tomorrow is I want to dive a little bit deeper into what we've simply looked at right now as far as corrective structures. Number one, kind of explain the foundational principles of the KCT technique, but also, two, all we've really looked at is the zigzag. So what we're going to be doing tomorrow is I'm going to show you some examples of how to draw a proper corrective price channel when the operative wave pattern is that of a flat, and also to the operative wave pattern is that of a contracting triangle. And then on Thursday, we'll go through and look at a bunch of examples. Okay? Well, that's about it for me for today. As always, thank you very, very much, and I will see you tomorrow.